All right, I haven't done a video in a while, and if you're familiar with the channel, you'll also notice a new background. Been busy, acquired a plumbing company January 1st. It's been an amazing experience and wanted to bring some of that experience into these videos with some information that I think will help both those of you looking at buying a business as well as potentially selling a business. There's a lot of information that can be overwhelming at first to anyone going through the process for the first time, so hopefully this will help out. And if you're new, my name is Rick Vazza. I'm a certified financial planner and president of Driven Wealth Management. And so what we're going to be talking about here is the process ultimately and some of the key terminologies included in buying and selling businesses. Now, first, when you're getting basically initiated to this space, you're going to hear a term called EBITDA pretty frequently. So what EBITDA is it's earnings before interest, taxes, depreciation, and amortization. It's essentially trying to get an earnings figure that can be used basically apples to apples across different businesses, no matter what their leverage, if they have any loan payments or anything like that, or if they own real estate and have significant depreciations or any sort of asset-heavy business. So that it gives you a little bit of a better apples to apples comparison. It's certainly not perfect by any means. There's plenty of complaints around EBITDA, but it is likely the most popular metric cited in the small business universe, especially when it comes into acquisitions. Now, when we get into the micro small business or the lower middle market, if you will, there's another term that is similar to EBITDA, but it's called SDE, and that's seller's discretionary earnings. And now that becomes a popular term as well, because what you're doing is you're taking EBITDA and you're basically adjusting it to a more pure form of what would be of interest to a potential acquirer. So like I do in most videos, I'm going to walk through this with a couple of examples to really drive home the point. But my goal is that this will give you a good understanding of some of the key terminology when used to value a business. And then in our next video, what we'll do is we'll take the information that we talked about here and we'll talk about how you actually start using that to apply toward valuation and starting to think about if a company is a good value for what their seller is asking for. All right, so let's dive in and just use a basic, we're just going to use some, again, back of the envelope math just to make the examples easy. This is by no means, the all-inclusive of every type of number that can come about, but just some kind of core things that are pretty common in this structure. So let's just first start with EBITDA. Again, what that was. So we have, so it's EBITDA, if you can read my atrocious handwriting. So again, this is earnings before interest, taxes, depreciation, and amortization. Again, just trying to get closer to an apples to apples comparison off of the earnings value of a company. Now, what we're doing with this, when we go into, let's say we have, just to make the example easy, we have 500,000 of EBITDA. Now, if you're a small business owner, chances are, you're doing some things smartly to reduce your tax burden. And of course, you're paying tax on the earnings that the business generates. So one of the ways to reduce tax is ultimately to reduce earnings. So it's not uncommon for accountants to help business owners figure out ways that they can reduce those earnings to pay less in taxes. Now, ultimately, it accrues the similar value to the owner, but really they're just trying to minimize that tax burden. There's the old saying, you're obviously going to pay what you owe in taxes, but there's no reason to leave a tip. So the accountant is oftentimes trying to figure out legal, appropriate ways that the business owner can take advantage of to reduce that tax burden. So enter seller's discretionary earnings. Because as the acquirer, what you care about is not necessarily the accounting value showcased on EBITDA, but you care about the true cash value that could accumulate to you as the potential acquirer of this business. So SDE, or seller's discretionary earnings, tends to be a pretty good metric to help get to that number. So what do? We take something like EBITDA and we're basically adding back or removing certain line items from either the P&L or the balance sheet that basically should be as if you were acquiring it, how that business would then look to you. So one easy example is, let's just say for a note payable. So let's say this business owner made $500,000, but let's just say, to make our math easy, they also paid $50,000 in debt payments, right? Maybe they had an SBA loan, maybe they had other sort of debt financing, it doesn't matter. But basically they had to make payments over the course of the year of $50,000. Well, typically when you're acquiring a business, you're going to buy it in many cases, especially in the small to medium-sized businesses, debt-free. So as the acquirer, you are not going to have that debt payment. So it could be a reasonable assumption to say, well, hey, actually, if this business did 500,000, the true SDE to an acquirer would be plus 50,000, right? Because that debt service payment that the owner had made on the previous business is no longer in existence. Now, would the debt payment fully show up in EBITDA? No, technically the principal is more of a balance sheet item and the interest is written off. But nonetheless, this is just an easy example just to showcase it. Again, this isn't meant to be accounting specific activities, but just kind of highlighting an example here. So let's just say hypothetically, though, this signals the true value of the company. Well, then you could add that 50,000 in. Another easy example would be, maybe the seller was using their own personal car or using a car to commute to work. So maybe they have car expenses associated with that, gas, maybe even car payments, whatever that could be. That might be another add back item. But then there's sometimes going to be things that maybe reduces an item. So now the key with seller's discretionary earnings is you're really trying to get a true value of what would accrue to you, if the business were still operating as is, but now you were the owner. That's really what you're trying to do, is basically redraft the financials in a way that makes sense to you as the new owner. Now, this can cause some back and forth between what should be included and what shouldn't be included. But I think it really helps if you're able to articulate that viewpoint of, hey, the way I'm getting here is if I'm putting myself in that seat, what are the actual line items that would be appropriate or not appropriate to include, and ultimately coming up with that final earnings number. So what is the amount that's actually accruing to the business that then you either have the ability to reinvest into the business, draw distributions from as an owner, whatever, use towards future growth at that point, whatever you want to do from a capital allocation standpoint. So that's a really helpful, just framework to think of, and I think can also help you in negotiations as you're discussing, how you're coming up with your valuation and where you got there. So again, this term is SDE. So these are probably the two most popular terms when you're thinking about valuation and just coming up with what's the earnings number that most business valuations are going to go off of. Typically, when we're kind of in that lower threshold, SDE is really popular. As you kind of get up to that next tier, you're going to start to see EBITDA cited more frequently. The two are fairly synonymous. There's clearly, as I identified, some changes that get made to the two to come to that actual number. But hopefully this just gives you a good line of sight into what those things are and some easy ways that you can kind of use that framework to start coming up with the true earnings potential of a business. As I mentioned, if you like this type of information, make sure you subscribe, because in our next video, we're going to actually talk about how do you then use these numbers to come up with the valuation of something that you would pay for the company. So we'll hit that in the next one. And as always, if you also enjoyed it, please hit the like button. It helps grow the channel and get more people to see this type of content, which I hope, especially nowadays, is really helpful as more and more people are interested in taking this path towards business ownership. Thank you again. Hope you enjoyed it, and we'll see you in the next video.